This is Charlie Gasparino. He says breaking: Wall Street executives who know Federal Reserve Chairman Jerome Powell say he wants to cut rates in June badly to match his guidance, but his inflation miscalculations are adding up to more. You see there, this is somewhat of the conventional wisdom forming today. In the meantime here, we spoke with also a member of the Federal Open Markets Committee and the president of the Federal Reserve Bank of San Francisco. Mary Daly is her name. Live Now look there in somewhat of an overcast, gloomy day there in San Francisco. You can see the Golden Gate Bridge there. And I asked President Daly, why is inflation going up? Will we see any rate cuts this year? And what are American consumers supposed to think, including going into this election year, on whether or not inflation is going to keep going up like it has the past 2 months? Here's our conversation. Why is inflation going up?
So inflation was always going to be a bumpy ride down to 2%. That's just something that historically happens, and this is no different. What we see is that services inflation, with the strength of the labor market and the strength of consumer demand, has really stayed strong. But let's remind ourselves, I think this is useful, it's always good to look back and see that in early 23, inflation was sticky, and then it fell rapidly at the end of 23. So this is why we at the Fed have been saying for a while now, we need to be data dependent. We need to respond to the economy as it evolves. And right now, policy is in a good place to do that.
You know, that's the operative word that I've been hearing a lot. We've been using it here on Live Now. Sticky. Can you still use that term in this CPI report? Is this still sticky or not? Is it something different?
Well, I think we need to stick with sticky right now, so to speak, until we learn more. So you could think that this is a sticky start to the year, which is what we saw last year, or you could think that it's indicative of more to come. And that's why we spend a considerable amount of time not just looking at the backward-looking data of the published releases, but also talking to firms, businesses, workers about what they're seeing in the economy. And we're hearing repeatedly that businesses don't expect to continue to raise prices as quickly as they did last year in the coming year, but it remains to be seen. It really depends on how the economy evolves. And as you can see from other data, consumers continue to spend, the labor market remains strong. We definitely are not done yet. That's the main thing. And there's no urgency, and I would underscore no urgency here, to adjust the policy rate when we have an economy that's growing as strongly as it is, and we have inflation that's not giving me the confidence I need to start thinking about cutting.
I see. So let's talk about cutting right now, because that's been the message, since December, that we would expect maybe 3 rate cuts, maybe 4 rate cuts in 2024. A lot of experts that I've been speaking with say it's just not likely this year at all, let alone in June, so to speak. So do you anticipate no cuts this year?
So I'm remaining open-minded here. I think it's not actually a good idea to do more than simply say how we expect the economy to evolve, because ultimately no one knows. You can only say what you expect. And, we have projections. We release them collectively 4 times a year. We released them in March from the FOMC. And the main message of projections is projections are not promises. They're simply a sense of where you expected the economy to evolve. And if the economy evolves as expected, this is the rate cut path we would think most likely. You're absolutely right that projection said 3 rate cuts as the median. But again, that happened in March, and we've received other data since then, and we have a lot more data to receive before we take any action. So I'm decidedly in the position of let's remain patient. Let's not urge ourselves to move in any direction. We've got the rate in a good place. It's restrictive, and we have to hold it there until we're confident that inflation is on a path to come down. And the last 3 months of data have not given me that confidence.
Yeah, I want to just kind of outline another maybe hypothetical situation, but other FOMC board members, Chairman Powell, have you been discussing the possibility of yet another rate hike this year? Is that on the table after numbers like the March CPI data we got today? Do you think that's going to happen?
Well, let me just, I don't want to divulge our conversations because, as you know, we release the minutes and that will tell you what we're thinking collectively. But what I would bring you back to is the summary of economic projections, that document we released in March. And what you saw there is a sense of it could be 2 rate cuts, it could be 3 rate cuts. That's where the bulk of the committee was. And I think that's a relevant place to start, that if the economy evolves with the policy rate where it is, we would expect that we'd begin to normalize as the economy slows. But what we're seeing is we're not there yet. And there's no urgency to adjust that policy rate now. But I don't think we should declare, just like I didn't think we should declare how many rate cuts we would have, I don't think we should declare that they're off the table. I think data dependence is hard because it says that you don't know, but it says that we're going to be watchful and we are ready to react to what the economy brings. The last 3 months of data tell me that we're not there yet.
Okay. Would you ever envision that 2% target rate would be moved, so to speak, the goalposts moved back, maybe at 3%, because it has been somewhat elusive. Yes, the downward trend toward 2% over the last 2 years has been steady, but the last 2 months it's been retreating from that target. Is that on the table as well? Maybe moving?
Absolutely not. No, there's no sense in which the American people wouldn't hold us accountable for saying, we thought we could do it, but we can't, because we have the tools and we have, most importantly, the commitment. We remain resolute to bring inflation to 2%, to restore price stability as we've defined it. It's more than just a number. It's a commitment to the American people that when they go to bed at night or get up in the morning, they don't have to worry about inflation. And right now, I'm not seeing that. Right now, people still, when I ask them, what's your number one concern? Inflation. And I think that's what we want to take away. We want to go back to a place where inflation's not people's number one concern. They return to their careers, their families, their communities. We're not there yet, but we're committed to getting there.
We got the jobs report for the month of March on Friday, 303,000 jobs added last month. Is the hot jobs numbers and the hot labor market, is it directly correlated to this kind of uptick there in inflation last month as well? Can you tie the two together, so to speak?
It's really hard to draw that conclusion without digging deeper into the information. And that's where remember I said just a moment ago that we spend a lot of time in the communities asking businesses and firms. And the thing about the labor market report that was perhaps surprising is that while we're adding these 330,000 jobs and the labor market remains very strong, you don't see a surge in wage inflation. And we're not hearing that from businesses. We're not hearing that workers are in there demanding even higher wage increases. But we have to continue to watch. The main thing that has been an ongoing surprise is the strength of consumer spending. Yeah. Now, consumer spending and the labor market go hand in hand. When people feel their jobs are secure and they're continuing to have many opportunities, they feel comfortable spending. That's the history lesson we all take. But it has been really surprising to me just how many people are still out there. I was in Las Vegas for a fireside chat and community meetings just last week, and airport's full, hotels are busy. They can't grow fast enough to keep track with all the consumers who want to come there and partake. And so it's just an ongoing strength of our economy, which in one way is fantastic. It's just we got to get inflation down to 2%.
Yeah, let's talk about consumer habits, consumer spending briefly. Like you alluded to, I mean, consumer sentiment is at a 30-year high. You kind of dig deeper under the hood there in the CPI data for last month. Homes, rents, and gas, that's really what went up. But you have that, and then you have consumer spending still high. So that leads me to believe, and maybe you're looking into this there, that it's not necessarily goods that Americans aren't necessarily spending their money on. It's, buying credit, so to speak, that it is so expensive to borrow money. Is that where we're seeing the inflation stick still, do you think, in credit?
I think when you dig into the inflation, what was really interesting is that what we call here, in San Francisco and in other parts of the Fed system, but in San Francisco, we published it on our website. We look at something we call supercore, and supercore excludes housing. And what you see is a pretty big rise in that supercore, and that includes things that are mostly services we all partake in. Think of leisure and hospitality and healthcare and all the other things that we go out and do. And that has been a strong part of the inflation picture. So it's not simply in housing or rent, it's really in those other sectors. And those sectors are more related to the strength of the labor market, the strength of consumer spending, and just the strength and the optimism in the overall economy.
Yeah. President Daley, we appreciate your time there up in San Francisco, and we'll talk soon. Thanks so much.
Thank you.